Okay, so this is something I used to talk in class about a lot, but obviously time has passed. 2008 is now a long way behind us. But some of you still might be interested in understanding the crisis and what the world went through in 2008, 2009. So I figured I would drag these notes out of their hiding place and at least give you the option to watch them if you're so inclined. So the 2008-2009 crisis in the United States was ultimately a financial crisis, but it came in some sense from a good place. It came from the housing market. And people need houses, right? People want to live in houses, and we created financial tools so people could get houses earlier in their lifetime. It's really tough to get houses. Imagine how tough it would be to buy your first house if you had to pay for your first house with 100% cash. By letting people get house loans, what we're doing is letting them get into home ownership further, channeling capital towards a socially productive use, letting people try to achieve the sort of life they want. That's a positive role. However, of course, nothing is perfect. When we talk about mortgages are an imperfect invention. They are an asset to the bank, to the lender, right? They are going to be collecting your mortgage payment. Who wants to enable someone to buy a house when that person is going to be able to repay the loan, right? So the bank is saying, we'll give you the money up front. The person buying the home is committing to giving a stream of payments over time. If that goes wrong, the bank can get the house back, right? We would say in the language of finance that the mortgage is collateralized by the house. The house serves as collateral. If you do not make the stream of payments associated with the mortgage, then the bank can take your house, right? Normally this is good, but sometimes this goes very, very bad. And in principle, both people are on the same side here, right? The bank wants you to make your payments. The bank would much rather receive its money without doing any work than go through the legal and complex hassle of taking your house and selling it. They want you to be able to make your payments. Here's what the US mortgage market looked like leading up to and after the years of the crisis. So this is just the amount of mortgages that were originated, the amount of mortgage loans people got. And you can see that there's this dramatic increase in mortgage origination going into the financial crisis. 2002, 2003, 4, 5, 6, really big years of people getting their first mortgage. But it doesn't look like this was about to reach a boiling point in 2006, 2007, right? It looks like the peak of the mortgage market was much earlier. However, if we want to think about all mortgages, that's true, but not all mortgages are the same. And in fact, every mortgage is different. Every mortgage is different because the value of your mortgage depends on who you are. How likely are you to keep your job? How likely are you to keep making payments? Where's your house located? Have you been taking good care of your house, right? All that sort of stuff, since it's a loan that's specific to you, who you are, where you live, your house, all those are important parts of the loan. The way the bank deals with this up front is that if they think you are a credit risk, you are maybe more likely to lose your job, you're not as likely to take care of the house, you're more likely to miss payments, they're going to charge you a higher interest rate to compensate for that risk. When we talk about subprime mortgages are just mortgages where the people receiving the money to buy houses are of relatively poor financial status. So there's going to be some cutoff lines that the financial industry uses, and if you are a relatively bad credit risk, you're going to be classified as subprime. If we look at the subprime mortgage market, now we can see the pattern leading up to the crisis. Subprime mortgages took off in 04, 05, 06, as the mortgage industry tried to keep the party going, right? If we go back to total mortgages, you can see that it peaks in 03. Imagine you're in the mortgage industry. Tons of people have just bought houses. There's not that many people left, right? It's not like people are buying 3, 4, 5 houses each. Most people sell a house, buy a house. Sell a house, buy a house, right? Most of us live in one house at one time. So I think in part as a search for volume, as a search for how can we keep mortgage originations at really, really high levels, the industry turned to lending a lot more to subprime people, right? So a much larger share of mortgage loans started being extended to these people with relatively poor credit, relatively weak financial capacity. This is also a little bit different in the United States and Canada, right? The United States treats mortgages differently than Canada does, and one crucial distinction is that in the United States, mortgage interest is tax deductible. So if you get a mortgage in the United States, you get a tax deduction. In Canada, you do not. So Americans are more interested generally in home ownership than Canadians because of that tax benefit. This is totally legitimate as a goal of public policy. I don't think it's a great instrument of public policy, but I think pretty much everyone can understand the appeal. That, we are trying to cut lower middle class people a break by saying, yeah, you just stretched yourself a little bit thin to get this first house. We're going to give you a little bit back on taxes because we think that home ownership is an important part of a successful society. Also, unlike in Canada, there are government-sponsored corporations or entities in the United States that have deliberate policy goals as set by Congress to try to promote low-income home ownership. These are called, often called Freddie and Fannie Mac, but there are others in this bucket, Ginnie Mae, and these are just corporations that are chartered by Congress, sort of like round corporations in Canada, where the goal is explicitly to make mortgages to people who are not being reached by the traditional financial sector. So more pressure in America to get the lower middle class into their own homes. We're also going to have different financial instruments and innovation in the United States. So one, again, unlike in Canada, the Americans are going to invent all sorts of different types of mortgages. In Canada, pretty much everyone gets a 5-year loan. Some people have fixed interest rates, some people have variable interest rates, but pretty much everyone gets a 5-year loan. In the United States, people were getting all sorts of weird deals, right? In the United States, most people get a one-shot 30-year loan, but people were also getting mortgages that said pay no interest for the first 2 years and then start paying interest in year 3. And so your payments would jump starting in year 3 as you sort of got out of this discount teaser rate. A lot more unique, aggressive, weirdly constructed mortgages designed to sell more mortgages. The 1980s is also going to start securitizing mortgages. And you see this graph here, right? It's got this distinction between securitized and non-securitized. So a security is just a type of financial asset that is amenable to trading. What exactly does that mean, to securitize a mortgage? Because you see that the vast majority of these subprime mortgages are indeed being securitized. Securitization is like trying to turn mortgages into stock market shares. If you say trade on the stock market for Microsoft or Apple or Nvidia, whoever else you might be buying shares in, every share of those companies is the same. Every one represents an identical piece of the same company. Very easy to trade because everyone is the same. But mortgages, we said, are all different. My mortgage is different than your mortgage by dint of who we are, our savings, our jobs, our houses, the location of our houses, etc., etc. If all the mortgages are different, then they're very tough to trade because you got to do research, you got to figure out what these mortgages are, etc., etc., etc. Securitizing mortgages is trying to convert individual mortgages into blended identical mortgages, right? We're trying to turn mortgages into shares. And the way that we do that is by creating a shell corporation, assigning a whole bunch of these mortgages to that shell corporation, and then selling shares in that shell corporation. So the idea being, while one mortgage might be a unique thing because it depends on my financial circumstances, 1,000th of 1,000 different mortgages, the individuals involved don't really matter. You can sort of think of this as a law of large numbers, a statistical argument. Whereas we take tiny slices of a whole bunch of different mortgages and push them together, the individual circumstances, that sort of noise will cancel each other out. Some people will keep their job, some people will lose their job, and those characteristics of the combined lot of mortgages should be predictable at an aggregate level, not an individual level. So here's a plot of mortgage securitization in the United States, and you can see pretty quickly that mortgage securitization is increasing dramatically going up to the crisis, right? You see Fannie Mae, Freddie Mac, Ginnie Mae, these are government-sponsored entities in the United States, explicitly chartered by Congress to go out and lend. But you also see the private sector getting heavily into mortgage securitization in the lead up to the crisis, right? So a lot more of these mortgages are being blended together. Banks and other financial institutions are taking pools of mortgages, jamming them into a shell company where they are all under the same ownership umbrella, and then selling pieces of this shell company to try to remove the individual risk associated with specific mortgages. People like this. Mortgages pay more interest than government bonds. If you could somehow remove the risk from mortgages that comes along with their individual circumstances and individual homeowners, you'd be taking very little risk, but you'd be getting a higher rate of interest. So lots of people are very interested in that, right? Bankers also like this because there are some fees. And all of this is good for the consumer in general, right? If banks want your mortgages because they're not as risky, because they can be securitized and blend it with other mortgages to remove idiosyncratic risk, and if bankers also want your mortgages because they can get some fees from carrying out this valuable risk-off transformation, they will they'd be willing through competition to give you lower interest rates, right? Making the product more desirable means that banks want to generate more mortgages. And how do you generate more mortgages? You offer people lower mortgage rates, right? Canada does this as well for the exact same reason. The Canada Mortgage Housing Corporation is a government entity which securitizes mortgages. They take regular Canadian mortgages, they blend them together with a whole bunch of other Canadian mortgages and sell the resulting puree. That puree should be safer, less risky than individual mortgages. That allows for people to get those mortgages at slightly lower rates because people want those mortgages that much more. So Canada we've talked about how Canada is different. Canada normally has 5-year mortgages, 30 in the United States. Canada also doesn't let you prepay your mortgages very effectively. So securitization is safer. In the United States, most mortgages come with an option that you can just pay off the balance whenever. So if interest rates move in your favor, you'll get another mortgage, pay off the entire balance of your old mortgage at the higher interest rate, and move forward at the lower interest rate. In Canada, you keep paying the mortgage. So in Canada, from the perspective of the bank, the mortgages are more stable because there's no chance of this interest rate go down. All the money floods in and you suddenly have to redeploy at a lower interest rate. In Canada, lenders have more ability to come after you, not just for your house, but for your paycheck, which is also an asset for the bank. Canada has stricter requirements for mortgage insurance. Again, good for the bank, but expensive for home buyers. And the Canadian Mortgage Housing Corporation is not as much of a political football as the entities in the States that are trying to get people into houses. So again, we're going to do the securitization process. We start a shell company. We buy or acquire 5,000 mortgages. We fold all those mortgages into the shell company. Now all the payments from that mortgages go into the shell company. Now people can sell shares of that, buy and sell chunks of that stream, chunks of that shell company to collect parts of the payments coming from that stream of mortgages, right? Diversification, right? We all have heard stories about how it's safer to own many stocks instead of one stock. Not all your eggs are in the same basket. This is exactly what's happening here. Securitization is diversifying risks across many mortgages. Sometimes these things are called mortgage-backed securities because the shares in the shell company that you own are backed by the mortgages. But we've transformed individual mortgages from illiquid, highly information-dependent instruments into liquid, information-independent instruments, right? These are also called collateralized debt obligations because there is collateral behind the debt, right? Now, but that covers anything else. You can collateralize credit card debt or auto debt or anything else. You can go even further than this, though, right? You could say, as opposed to just splitting the shell company into a whole bunch of pieces like shares, you could split them into shares that are not all the same. Just like when you're splitting a cake, you've got edge pieces without much icing and edge pieces with icing and center pieces without much icing. You're doing the same thing with your mortgage shell company, right? You could say, we're going to create multiple parts of this shell company. One part is going to be the senior chunk, or what a financier would call the senior tranche. This is going to have the highest priority in claims. And then you could say there's other shares, other tranches, other pieces of this company, but they have different rights. So we are chopping up this mortgage shell company, saying this is the riskiest piece, this is the second riskiest piece, this is the third riskiest piece, this is the safest piece. And we want to cut the cake up or cut the shell company up because people have different preferences over cake when they're eating, and they have different preferences over risk in financial markets. Some people are going to want really safe securities, and some people are willing to accept higher risk for higher reward. So by chopping the company up into different pieces that are going from risky to super safe, you're creating different characteristics that you can sell to different buyers. You can go even further. You can then take those pieces of companies, start new shell companies, and say these new shell companies are comprised not of mortgages, but they're comprised of different purees. So I make a shell company with 5,000 mortgages. Another person makes a shell company with 5,000 mortgages, and then we cut both of those companies into tranches, into pieces. A third shell company comes along and starts buying pieces that we just sold, wrapping them into a third shell company, and then cutting that company into pieces, right? Anytime you've got, assets, they can be rebundled into more and more shell companies ad infinitum, as long as you're willing to keep paying the lawyers to create more and more layers of shell corporations. And again, in principle, all of this is good. We are trying to diversify risk, reduce risk, and allocate risk to people who want to bear it, removing risk from people who don't want to bear it, right? All of that has potential. The finance industry is at work pushing risk to the places where it belongs, where people want to hold that risk, and diversifying as much of that risk away as is possible. And that seemed really good because nothing was going wrong. And why was nothing ever going wrong in this model? First of all, in the 2000s, house prices were rising. I know, how strange, house prices are rising. It seems like house prices are always rising. But house prices were always rising. And when house prices are really rising, nobody ever stops paying their mortgage. If your house has gone up a lot in value and you're struggling to pay the mortgage, you just get a loan against the increased value of your house and you're good. So when house prices are rising quickly, everyone has enough capital to always pay the mortgage. People still want these mortgages to securitize. There's profits involved. It seems like we're doing a good job at diversifying risk. Everyone seems to be better off. But behind the scenes, lending standards, as we saw, right, we're getting a lot more of this subprime lending. Banks are not holding customers to the same standards when they make loans. In part, this is because these political actors are trying to make a lot of loans, trying to keep market share, trying to keep pushing people into houses. And in part because of securitization, right? Securitization is going to reduce lending standards because you're not going to hold the mortgage. Imagine you're a small town community banker. You make a mortgage loan to someone in your community. You are going to do your research about that person because you're going to be stuck with that debt for 30 years. But if you're making a loan and then you're selling it to a mortgage security company in 2 weeks, do you really care about that person's characteristics or financial status? You only need them to pay the mortgage for 2 weeks. Then you're selling it. It's moving on, right? So the process of securitization divorced the people who were making these loans from the people who had the incentive to care about these loans coming good. And so at the beginning of the funnel, the people who making the loans start making a lot more subprime loans because they know they're going to sell these mortgages on and they're not going to be on the hook in the long term. They just want to juice the numbers as much as possible because that's where their money comes from. It's the people on the other end of the funnel of this securitization and CDO and chopping and pureeing and combining process who care about lending standards, but they're not the ones making the loan. Right? Again, if you look at American house prices doubled in the 7 years going up to the financial crisis. Really, really strong home price growth. So although lending standards were decaying, everyone was making so much money from owning a house that nobody was going bankrupt. Really good. So these banks, right, who are originating the mortgages don't care about the long term. We're creating this illusion of safety where banks are originating mortgages, that is making loans to people who want to buy houses, packaging and combining and dividing and tranching and repackaging and retranching. And that blending process through many, many stages is obscuring to the eventual person who's holding this puree of the characteristics of the people holding the loans, making the payments, right? If there's no intermediaries, the bank makes the loan, the bank collects the payments, the bank closely sees who's the quality of the mortgage borrower. But if the bank makes a loan and then that loan gets passed through 18 shell companies where it's being combined and tranched and resold and repackaged, the person at the end of that process has no idea really or at least at the time, was not doing the research to really find out about the quality of these people who were getting the mortgages. Ratings agencies are supposed to be one of the social institutions that fight against this. So rating agencies are for-profit companies that do bond research for individuals. So imagine you're going to invest in a mortgage company and you don't have the time to research 5,000 mortgages. You go to a ratings agency and you pay them to do it. So they will send the researchers to do the research, and they will assign these products a credit rating like A or A plus or capital A, 2 little a's, right? There's a whole bunch of these letter grades. AAA is the best, AA is great, and then it moves down. So like an A minus is a lot worse than a AAA, and a B plus plus would be worse than an A minus, right? Just like a grading system in university. Rating agencies gave these things great reviews. Some of these products were really, really complicated. The researchers couldn't really get a meaningful hold on them, especially given the cost of doing the research, right? Like you're going to go to all these houses and investigate one by one. And also, ratings agencies being a for-profit business means that companies wanted the best grades, so we had grade inflation, just like we do in university. You go to the professor who gives you the best grades, you go to the ratings agency that gives you the best grades. And so all the ratings agencies have an incentive to give great grades. So the ratings agencies didn't really do the research, and they just certified that these things were safe, even if they weren't necessarily great products, and people trusted them. Economists knew all this. Nobody believes this, but there's lots of pre-crash literature written by very prominent economists saying that stuff is going wrong. We didn't know exactly what it was, but we certainly saw that things were going really wrong. So things were not necessarily wrong, but we could see that things were really weird things were happening in this housing CDO market, right? And you can go read these papers if you're really inclined. But as economists from the outside, they're my tribe, we didn't know exactly what was happening. We could say, look at the data, this data is really weird, but we couldn't say exactly what was going wrong or what was causing this inconsistency, right? Were mortgages being priced incorrectly? Was default insurance prices wrong? Who knew, right? There's lots of pieces in the mortgage market, and we only saw the mortgage market from the outside. So there was some evidence that things were going wrong. We just didn't know what. This is very common, right? Financial crises are inherently unpredictable, because if they were predictable, they would not be crises. If you say that this is going to collapse in 2 years, people will change their behavior, right? The moment you figure out something is wrong, that's when the system is collapsing. There's no such thing as figuring out a collapse is going to come and then the collapse waiting patiently while you resolve the problem, right? The moment that someone figures out that this asset is toxic, people want out of this asset. It's immediately worth less, right? It's just not. It's intrinsically impossible. We can't predict the weather a year from now. If we could predict the weather from now, we'd change our behavior. The moment that people figured out that these bonds were not what they seemed, they were immediately worth less. The financial crisis is immediate the moment you realize it. So here's an example of one of the pieces of research that was circulating at the time, right? So before the crisis, this had been written for several years. It had gone on the road. The authors had been in communication with the financial industry. Lots of people had commented on this. I'll quote, "In fixed income markets, i.e. in housing debt markets, investors focus exclusively on estimates of expected payoffs, such as credit ratings, without considering the state of the economy in which default is likely to occur." So we look at the A+ credit rating, but we don't think about the economic circumstances where this thing could go bad. If you're this sort of person, you are likely to be attracted to securities whose payoffs resemble those of catastrophe bonds, bonds that default only under severe economic conditions, right? When do people stop paying their mortgages? When the economy is in trouble, right? So when the economy is in trouble is exactly when all these mortgage bonds are going to blow up. We show that many structured finance instruments, housing bonds, can be characterized as catastrophe bonds but offer far less compensation than alternatives with comparable payoff profiles. So people are buying these mortgages but getting much less payoff than when they buy other products that are also going to blow up in a financial crisis, which suggests that people are systematically underestimating the true risk of these products. We argue that this difference arises from the willingness of rating agencies to certify structured products with a low default likelihood is safe and from a large supply of investors who view them as such. So the ratings agencies and the investors are perhaps oblivious to the downside potential here. In explicit investments where there's clear possibility of blow-up, people demand a much higher risk premium. They demand higher interest rates, higher compensation for lending. But here, something was going wrong because these things could blow up, but people were not getting paid as much, suggesting that they were underestimating the risk of these things. We knew. What goes up cannot go up at exponential rates forever. Eventually, home prices plateau. There's just no more excess demand. House prices have gone up a lot, so builders are building tons of houses, so supply expands dramatically. Demand is stagnant. Prices start plateauing. When prices stop going up, people start struggling to make their mortgage payments because they can no longer cash out extra equity, extra profits from their house. People stop paying their mortgages. People start defaulting on their mortgages. People who are defaulting their mortgages are losing their homes. They're selling their homes. Now there's more supply of homes. Home prices start falling, and this vicious cycle begins. As people stop making their mortgage payments, more houses hit the market, house prices go down even further, more people stop paying their mortgage, and now we've got this rolling rock going downhill. By the end of 2011, 1 in 9 Americans who owns a home are not paying their mortgage. And those, like people who own their home, are better off than average. So we have really nationally widespread economic distress. And as people stop paying their mortgages, money stops flowing in to these mortgage puree companies. And the risky chunks of these companies are rapidly becoming worthless because there's no money coming in, where the owners expected to receive these mortgage payments. But this is still not a total crash. Back then, taking the value of the U.S. housing market, imagine that 11% of American mortgages lose half their value. Their owners can only repay half the mortgage loan. That's a $500 billion loss. That's about the same as the world stock market going down 1%. Happens all the time. How can this expand? We need a bigger shock to the system, because if 10% of American mortgages lose half their value, that's just not a big enough number to collapse the global financial system. But quickly, the global financial system starts blowing up in 2008 with Bear Stearns and later Lehman by September. So things are blowing up. Part of this story now becomes about credit default swaps, which is just an insurance on a financial product. You are paying to swap the risk of default on someone else. Insurance is a good product. I own house insurance. I own car insurance. I like being in a society that sells insurance. And other people might want to buy insurance on their portfolio. So you say, I own all these mortgage bonds. I'm going to buy insurance on these mortgage bonds. So if these mortgage bonds go bad, the insurance company, the bank, is going to pay me out. Just like when I get into a car accident, the insurance company pays me out for my car accident. People thought these mortgage bonds were very safe, and so insurance on these things was really cheap, right? Your insurance cost depends on the risk of accident. Risky drivers pay more, safe drivers pay less. Risky assets demand high insurance premiums, safe assets demand low insurance premiums. So buying these insurance products was something that people just did because they wanted insurance on their mortgage bonds, but it's also how others, onlookers, shorted the housing market. They never bought the mortgages themselves, but they bought these insurance swap products that were going to pay off if the mortgages got into big financial trouble, right? So writing a credit default swap, like an insurance contract, brings in cash. Right? I pay my car insurance company every month. Financial companies like AIG were writing these insurance contracts to bring in money. We write insurance on mortgage bonds, and the holders of the insurance bonds pay us a monthly premium. Great, as long as the housing market didn't go up. This is a wonderful product in principle. The presence of an insurance market allows everyone to see exactly how risky these things are, right? Everyone could go to the insurance market, look at the price of insurance, and say, banks are charging this much for insurance. That's telling me something about how risky these products are, right? It's sending information to the whole market about the risk inherent in these products. That's great. It's exactly what we want. But this fire alarm wasn't going off because the rating agencies and the investors were oblivious to the true risk of these products. And so the insurance was very, very cheap, and nobody was, the fire alarm bell was not ringing that these things were actually quite risky. The key thing is that we start taking losses on mortgages, and now other people start losing on their mortgage insurance contract bets. But the key thing is that the market for bets can be much bigger than the amount of insurance. In the movie The Big Short, the way they explain this is with a casino. Someone goes to the casino and plays roulette and puts down $100. They're betting $100, but behind them, other people are betting on them. And it's like if the person at the blackjack or the roulette table is putting down $100, and the people behind them watching are betting thousands of dollars amongst themselves on what's going to happen. So as many of these secondary bets can be placed, right? To get a mortgage, someone has to actually take out a mortgage and buy a house. But the market for bets on mortgages can be infinite. We can place as many bets on mortgages. Just like you can bet as much money on a soccer game or a hockey game as you want, you can bet as much on a mortgage as you want. So the market for bets can be much, much larger than the market for mortgages. And it was indeed about 6 times as big. So now we are getting towards a crisis, right? It wasn't just the size of the mortgage market going bad. It was the fact that there was this giant stack of bets overlaid on top of the mortgage market. And lots of people had good reason to do this. Again, I want car insurance. There's a good reason to have car insurance. There's a good reason to have mortgage insurance products. Lots of good reasons. But it created a much bigger problem by volume. You can go even further. You can say, well, what's an insurance contract? An insurance contract is something that pays a stream of income. So you can start creating synthetic shell companies that are not full of mortgages, but are full of bets on mortgages. So instead of blending together mortgages in a shell company, we place bets on other people's mortgages, and now we blend those bets on other people's mortgages into another shell company. That's a synthetic CDO. So it's a mortgage-backed security with no actual mortgages involved, just bets on mortgages. But if the mortgages are safe, the bets on mortgages should be pretty safe too, right? So there's no real difference, right? You can, just like with one mortgage, you can have 10 bets. With one mortgage puree company, you can have 10 synthetic bets on mortgage puree companies. And these were called synthetic CDOs because there was no real mortgages involved, but they paid off the same as the mortgages because they were bets on the underlying mortgages. So, right, we had a giant synthetic CDO, which was almost as big as the real CDO market. So this insurance market is normally healthy, but it made the problem a lot better. So in 2008, the people who had made bets on these insurance products on the losing side were starting to blow up. These weren't enough to tank the institutions immediately, but some people said, wow, Bear Stearns is losing a bunch of mortgages. Maybe I better take my money out of Bear Stearns. Lehman is losing a bunch of money on mortgages. I better stop doing business with Lehman. They're dangerous. And so now you've got a bank run, right? People are seeing the losses that these companies are incurring. They're saying, wow, these companies are struggling. I'm going to pull my money out. I'm going to make the problem worse. These things start to collapse as people, investors, shareholders, and counterparties of these corporations start fleeing, right? This risk starts to propagate through the financial system. Maybe I placed a bet on Bear Stearns, an American investment brokerage that went bankrupt. I want Bear Stearns to pay me out when the mortgage market collapsed. That's what I bet on, right? I bought this insurance product on mortgages because I believed that Bear was going to pay me out. But now Bear is going bankrupt and they're not going to pay me out. So I'm losing as well, right? It's like if you got into a car crash and your insurance company went bankrupt, so they didn't pay you out. Now you're in big financial trouble as well. And so you've got this chain reaction where the people who did business with the people who lost money also start to lose money. And that chain started to propagate. This is one of the reasons that people use the term too big to fail. We need to keep financial companies small because when one collapses, the people who do business with them are also hurt. And it's like sort of dropping a bomb. So no company can be too big, so the domino effect of a collapse is not that big. That's fine, but the problem is that if all the banks are doing the same sort of business, they're all going to go bankrupt at the same time anyway, right? The too big to fail argument only works if you think that banks are behaving in systematically different ways than one another. So the policy response at the Federal Reserve is to print a whole lot of money. This was a little bit of a bailout because they had to pay above market prices, right? When the crisis hits, everyone considers these mortgage assets toxic. They're trading for very low prices. The Fed has to buy them at a higher price. Because if the Fed buys them at market price, they're just going to crystallize the losses, right? Bear owns these mortgage products at, say, par of $100. They're now trading at 30. If the Fed buys them at 30, all they've done is lock in the loss for Bear. And there's no way back out for the company then. So the Fed does pay above market prices, but in a panic fire sale, maybe the market prices are not really fair prices. But you can definitely accuse, if there was a bailout, it was not that the central bank gave these companies money. It was that they bought their assets at an above market rate. And you can see that in the Federal Reserve balance sheet, right? So right here, this giant spike is exactly when all the money printing started. How do central banks acquire assets? They print money and use the freshly printed money to create bonds. That big red and orange chunks are the Fed bringing in assets onto its balance sheet, bringing in mortgage-backed securities, MBS, pulling risky financial assets out of the financial system and injecting with cash, right? The Fed's balance sheet mimics the cash it injected because it buys $1,000 of mortgage-backed securities. It pays for it with freshly created cash. So you can see the immediate massive money creation that happened in the guts of the pandemic. The massive recession response, real investment falls a quarter. The stock market is down 40%. Consumption only down about 3%. Again, people really don't want to cut back on consumption. You can't really cut back on food. You can't cut back on your electric bill. And I've got some stuff in here that speaks to more advanced macroeconomic theory. One of the issues, ZLB, zero lower bound, is the idea that you might want to bring interest rates below zero, right? When the Fed stimulates the economy, they bring interest rates down towards zero. They print money, they make the money available. They lower interest rates, they help more people invest. But you can't bring the interest rate below zero, and so there's a limit to how much the Fed can do. Once you bring interest rates down to zero, you just start printing money to try to remove risk from the financial system, right? So we often just say moving interest rates is not really quantitative easing. Quantitative easing is when you're injecting money beyond just trying to manipulate interest rates. Okay, so that's pretty much all I have to say. Hopefully that was a reasonable primer on the crisis. Obviously, we could get way more deeply into the aftermath and all the details here, but I think hopefully that gives you a reasonable picture of what happened.